Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a LIBOR loan, and we're going to be calculating the effective interest rate on a LIBOR loan, which is basically going to be a loan that's going to have a little bit different of a structure to it, including a fee for it, and therefore we want to be able to compare and contrast it to basically normal loans, which we will use the effective interest method or the effective interest rate to do. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 818 LIBOR Loan Effective Interest Rate tab in the Practice Problems section. Closing this back out, we're going to have the information up top. We'll use that to work through the problem down below. So what we're going to have is a loan, which we're going to call a LIBOR loan. It's going to be structured in a bit different way, and it's going to be including then a fee. So we're going to have a fee that will be included in on it. Now, once you think about a loan, if you start saying, okay, should I take this loan or the other loan? And usually the cost of the loan is expressed in the terms of interest. Interest is like the rent on the loan. That's the fee of the loan. But now you tacked on this other thing, this fee with it. How can I compare and contrast something now that you're not, you kind of deviated from the standard we normally have, which is to calculate the cost of the loan simply with the interest. And we'll use our effective interest rate formula to do so. So let's say we're going to borrow the $10,000. We're going to say it's going to be a 1-year loan. We'll make it nice and easy. So it'll be a 1-year loan. So we don't have to worry about that T factor because it's going to be 1 in our formula down here below. And the terms, we could say we can get a prime loan with the prime rate, which would simply be the 9%. So we could take out the loan at the 9%, and that would be our normal kind of process. So we'd say, all right, well, if I took out a loan, if I got the $10,000 loan, if it was for 1 year, what's going to be the cost of that loan? Well, I've multiplied times 9%, 0.09 times the T, so P times R times T, and so T would just be 1 because it's going to be 12 months over 12 months or 360 over 360, and that's just going to be the 900. So it would cost me 900. So I would take then the $10,000 loan. If it was just a normal 1-year loan, we would get the purchasing power of that loan over that time period. We'd have to pay back the principal, which would be the $10,000, and basically the rent on that, or the cost of the loan, which would be $900 at the end of that time period. That's our normal kind of structure that we would think about. So it costs us $900. But what if we got this LIBOR loan where it says basically they're going to take the prime rate and say -1, which would mean that would be 8% rate. So it's like, all right, that's straightforward. That's 8%. But then they're going to tack on this fee of the $105 for the fee for the loan. And that kind of complicates things because now normally, I mean, if it was just an 8%, I'd say, well, then I'd want this loan because it would be at 8% rather than 9%, which is better if it was, everything else equal. However, now you tacked on this fee of $105, and that's tacked on to the normal cost of the loan, which is simply usually just expressed in terms of the interest rate or the interest on the loan. So how can I decide which loan to take? Well, we got to standardize it once again with the use of our effective interest rate calculation. So we're gonna do that down below. We're gonna say, all right, how can I standardize this thing? This is going to be our formula once again. We could start from here. Interest equals principal or the loan amount times the rate, which is the rate for an entire year typically, right? That's what the rate usually will be expressed in, times T, which is time, and that's going to be a fraction if it's less than a year, right? Which would be, the fraction of the year over the year. So if it was days, the fraction of the time period divided by 360 or 365, we're going to be using the 360. If we were then to convert that to this formula, we would say, all right, if we're going to take this and convert it to find the rate, which was what we're going to basically do for the effective interest rate, it would be the rate equals I, or interest, divided by P, or the loan amount, times T, and that's going to be time once again, which is going to be our fraction down below. Now, note that when we think about interest in this case, we're thinking about the cost of the loan. What is the cost of the loan? And since they tacked on a fee, which is basically part of the cost of the loan, the tricky thing is we're going to include that in interest. We're basically going to say, hey, that's like interest because that's part of the cost of the loan. So that we're going to include that in the interest calculation, and then we'll do our normal kind of calculation. So we could break this out in this format by taking this T, this ratio down below, and putting it in this format, which would be the interest divided by the principal times the inverse of the ratio of the year, which would be the days in the year, 360 in our case, divided by the days of the loan, in days of the loan, which is just going to be the same because it's a 1-year loan. All right, so let's do it. We're going to do it with this calculation, and then we'll do it with this calculation. All right, so we're going to say the effective interest rate. I'm going to calculate the first half here, interest divided by principal, and then we'll do the second half, and then we'll multiply them out. Interest and fees. This is the key component. We're not just taking the interest on this, we're going to take the interest and the fees. So in other words, you'd say, well, the interest on this is going to be the 9% minus the 1%. Well, that's easy. That's 0.09 minus 0.01 gives us 8% that we would have on the interest on the loan, which is times 10,000. 10,000. So there's the 800. But then we're also going to say the cost of the loan, which is basically like interest, is the fee. They tacked on this just standard fee of 105. So we're just going to include that as basically the cost of the loan, which we're going to put into our formula as basically interest. So we're going to say, okay, that's kind of like the cost of the loan, that's interest. That's going to be then our I calculation, our interest calculation. And then we're going to say that the denominator is the loan, just standard. It's going to be the principal of the loan. So the 905 divided by the 10,000 gives us about 0.090500. And then I'll do the second half, which is going to be the days in the year, 360 divided by the days of the loan. This will be nice and easy because it's a 1-year loan. Therefore, the days in the year, assuming even months of 30-day months, times 12, 360, divided by the loan, which is for 1 year as well, also 360. 360 divided by 360 is 1. And therefore, we can then multiply or times these two out. So we got the 0.0905 times 1. If I move the decimal over, that's 9.05%, 9.05%. So that percent then is higher than just the prime rate. So if I was able to get then, if I was comparing this out and I can get a loan, just a normal loan at the 9%, as opposed to the LIBOR loan, which is at 8%, but tax on the fee, it looks like the standard loan at the 9% would be better, given the fact that the effective interest rate, if I add in the fee, to the other loan is going to be a little bit higher. So let's do that calculation one more time. We'll do it down here, and now I'll just simply do it with this calculation. So instead of converting it from here to here, we'll just use this. So that's going to be interest divided by P times T. So once again, the key point here is this interest is not just simply going to be the interest of the loan, but the interest and the fee, the cost of the loan. And then we can use this to compare out. So we're going to say the interest and the fee. Once again, if we took the 10,000, like the rate was on this loan that we're comparing to is 1% less. That's not a problem. 0.09 minus 0.01 is 8 times $10,000 loan. That's normal. But then we tacked on plus this 105, which is basically, again, the cost of the loan. So now we're at the 905. And then we've got the principal. So we're taking the interest divided by the principal times time. The principal is going to be 10,000. Straightforward. The percent of the year is going to be time, which is going to be easy this time because it's a full year. So the days of the loan are 360 days of the year, assuming even 30-day chunks. 30 times 12 days in a year are going to be 360. Dividing that out, we're going to get 1. 360 divided by 360 is 1. So now we've got P and T, 10,000 and 1, to give us the denominator of 10,000. So now we've got I, interest, which is interest and the fee, divided by P times T, or 10,000, is once again going to give us that 9.05. If we were to double check that number, see if that rate makes sense, we can plug it back into this formula and solve for I, or interest, by taking the P, or the loan amount, times the rate, which is the rate for a year, times time, which is simply going to be the 1 year in this case. We could say, all right, well, then if I think about this, we got the loan, which is 10,000, times the rate, which we said was 0.095, which is that right? No, 0.0905, and then times the percent of a year, which is just 1 is 905. That gives us the 905, which we would think of as the interest, but now effective interest rate, which includes the cost of the loan, which includes what we would think of as interest on this particular loan plus the fee, which is basically pretty much like interest, right? That's the cost of the loan that we have. So we're going to say it's the 905, and that allows us, this rate then allows us to do some normal comparison to like a standard loan. We're trying to standardize this thing so that we can do comparisons to other loans in a standard type of format.